Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SAFEHOLD Inc. Annual Report. SAFEHOLD Inc. offers a range of businesses and services that cater to the needs of property owners. At its core, the company provides ground leases for high-quality properties such as multifamily, office, industrial, hospitality, student housing, life science, and mixed-use buildings. This innovative approach allows property owners to unlock the value of their land while minimizing risk. By leveraging the ground lease model, SAFEHOLD enables property owners to generate higher returns on their investments. The company's services are designed to provide a safe and growing income stream for its shareholders, in addition to long-term capital appreciation. As a real estate investment trust, REIT, SAFEHOLD is well-positioned to deliver stable and predictable returns to its investors. The company's expertise spans various property types, making it a one-stop shop for property owners seeking to optimize their investments. With a focus on delivering value to both property owners and shareholders, SAFEHOLD continues to revolutionize the real estate industry with its modern ground lease model. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what might cause a stock's price to remain stagnant over a period of time. The stock market is inherently unpredictable, and there are numerous factors that can contribute to a company's stock price remaining unchanged for an extended period. One possible reason is a lack of significant news or events that would impact the company's performance or industry trends. This could be due to the company being in a stable phase, with no major announcements or developments that would drive up or down its stock price. Another factor could be the overall market conditions. If the broader market is experiencing a period of stagnation or volatility, it may not be surprising to see individual stocks remaining flat as well. Additionally, if a company's financials are stable but not particularly impressive, investors may not see enough growth potential to justify buying or selling shares. Furthermore, regulatory issues or changes in industry regulations can also impact a company's stock price. If a company is facing increased competition or struggling with operational challenges, its stock price may remain stagnant as well. Ultimately, the reasons for a stock's lack of movement are often complex and multifaceted, requiring a deep dive into the company's financials, industry trends, and market conditions to fully understand. In conclusion, there could be several reasons why SAFEHOLD Inc.'s stock price has remained unchanged over the past year. It is essential to consider various factors, including market conditions, regulatory issues, and operational challenges, to gain a comprehensive understanding of the situation. SAFEHOLD Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $4 billion. SAFEHOLD Inc. trades at a lower price-to-earnings ratio of 10 times and a lower price-to-book ratio of 0.47 times relative within the industry. This suggests a potential market detachment, as SAFEHOLD Inc. trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.53%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified through a review of various factors. On the growth side, contractual base rent increases, long-term leases with periodic rent hikes, capital appreciation, interest income from sales-type leases, operating lease income, ground lease payments, property net operating income, and rent escalation clauses all contribute to increased revenue. On the other hand, tenant defaults on lease agreements, economic downturns affecting office space demand, material vacancies in office assets, poor hotel performance, disputes with tenants, above-market lease assets, and in-place lease assets are among the primary drivers of revenue decline. Additionally, market conditions, trading price of common stock, capital needs, funding source determinations by management, and share repurchase programs also impact revenue growth or decline. Net income experienced a significant shift between 2023 and 2025. Initially, it transitioned from a net loss of -$54,565 in 2023 to a net income of $114,630 in 2025, indicating a substantial improvement. Furthermore, the net income increased by 7.1% from 2024 to 2025, which is a notable increase. However, there were instances where net income decreased due to changes in interest rates. For instance, it decreased by $3,516 when interest rates rose by 50 basis points, and by $6,985 when they increased by 100 basis points. Conversely, a 10 basis point decrease in interest rates led to an increase of $703. Profit margins also underwent changes during this period. They improved from a loss to a significant gain over the 3-year span. Specifically, profit margins increased from 29.2% in 2024 to 29.8% in 2025, indicating a slight improvement. Nevertheless, there was an instance where profit margins decreased from 61.6% in 2024 to 30.1% in 2025, which is a notable decline. The fluctuations in net income and profit margins can be attributed to the changes in interest rates. When interest rates rose, it led to decreases in net income, while a decrease in interest rates resulted in an increase. The improvement in profit margins over the 3-year period suggests that the company's financial performance has been on an upward trend. The company's financial performance is a notable aspect of its overall health. A key indicator of this is the generation of positive operating cash flow. According to the provided information, the company has successfully achieved this milestone in both 2024 and 2025. On page 36, it is stated that the operating cash flow for 2025 amounts to $47,814,000. This figure not only indicates a significant increase from previous years, but also underscores the company's ability to generate substantial revenue from its core operations. Furthermore, as confirmed on page 55, both 2024 and 2025 have seen positive operating cash flows. This achievement is a testament to the company's efficient management of resources and its ability to navigate market fluctuations effectively. The consistent generation of positive operating cash flow suggests that the company is well-positioned for future growth and success. The company's financial situation has undergone significant changes. The data shows that the company's debt level has increased substantially over the past year. According to the reports, total debt obligations have risen from $4,372,317 to $4,585,887, a notable increase of $213,570. Furthermore, the net debt has also seen an increase from $4,317 to $4,586. In addition to the rising debt level, interest expenses have also increased significantly. The reports indicate that interest expense rose by 4.37% from 2024 to 2025, amounting to a substantial increase of $8,644,000. This is attributed to an increase in total unsecured financing from $2,874,204 to $3,369,478. Overall, the company's financial situation has become more burdensome due to the significant increases in debt level and interest expenses. These changes are likely to have a substantial impact on the company's operations and profitability. SAFEHOLD Inc. is committed to its strategy of acquiring, managing, and capitalizing ground leases for stable and increasing revenue. The company's approach focuses on long-term investments, targeting properties with initial costs representing 30–45% of the combined property value, and a net operating income to ground lease payment ratio between 2.0x to 4.5x. This ensures that the company can generate consistent returns while minimizing risk. In addition to its individual investment strategy, SAFEHOLD Inc. has also formed a joint venture with a sovereign wealth fund to acquire new ground lease investments. The company will commit approximately $1 billion for a 90% controlling interest and receive a management fee and promote on invested equity in the joint venture. This partnership not only provides access to additional capital, but also enhances the company's financial position, which was already strong as of December 31, 2025. The company's focus on contractual rent escalation clauses, or percentage rent participating in gross revenues, further supports its goal of generating safe and growing income. By incorporating these features into its ground leases, SAFEHOLD Inc. can ensure that its revenue streams are protected against inflation and other market fluctuations. Overall, the company's strategy appears to be well-positioned for long-term success, with a strong financial foundation and a clear focus on generating stable and increasing returns. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has acquired 2 hotel properties that reverted back to it on January 1, 2026, as well as all Carrot units to consummate a change of control or the sale of its ground lease business. Additionally, the company merged with Old Safe and acquired 2 more hotel properties that reverted to it in 2026. In terms of divestitures, the company has made some significant moves. It was forced to dispose of 1 or more assets on disadvantageous terms due to debt obligations. The company also sold its ground lease business as part of a larger transaction involving the acquisition of Carrot units. These transactions demonstrate the company's efforts to restructure and adapt to changing market conditions. The merger with Old Safe in 2023 was a significant acquisition for the company, bringing new assets and opportunities under its umbrella. The acquisitions of hotel properties that reverted back to the company in 2026 also highlight the company's focus on expanding its portfolio and increasing its presence in the market. The company has demonstrated its commitment to returning value to shareholders through 2 key initiatives. Firstly, it has paid dividends to its investors, with specific amounts detailed on pages 55 and 88 of the report. This indicates that the company is prioritizing shareholder returns and rewarding its investors for their loyalty. In addition to paying dividends, the company has also engaged in share buybacks, a strategic move aimed at enhancing shareholder value. On February 4, 2025, it authorized up to $50 million for this purpose, as mentioned on page 29 of the report. Furthermore, a share repurchase program is also highlighted on page 25, underscoring the company's dedication to maximizing returns for its shareholders through various means. Concerns over inventory buildup or supply chain disruption are present in the current situation. One major issue is related to ground leases with developers, which could potentially disrupt the supply chain. This concern is highlighted in a specific section of the report. Furthermore, there is also a concern about external capital sources due to limited depreciation expenses and potential unfavorable capital markets. This could impact the company's ability to secure necessary funds for operations, leading to potential disruptions in the supply chain. That concludes the financial summary for SAFEHOLD Inc. Feel free to comment below, and I will be happy to answer them when possible.